The reason I'm talking about this is that the current context necessitates a certain change, maybe in the thinking that some investors will have to have. Amol Joshi, the founder of PlanRupee Investment Services, is joining me to talk about equity savings schemes. Amol, thanks so much as always for taking the time. Let me start by asking you about the current context. Before we get into equity savings schemes, we've seen risk assets globally being sold into. You've seen bond yields spiking, though in the last couple of days they've come off from the highs, and one would hope that in the near term at least some of that volatility will get curbed. But how should an investor who has gotten used to a certain move in equity markets over the past couple of years uh, change their perception to make sense of the current world order?
Right, Alex. So once again, thanks for having me on the show. And this equity market phase goes on to reiterate what we have always said, what we have always preached to all our investors. That equity, and I agree with your point that investors have gotten used to a certain kind of market over the last 2 years. But this phase is an aberration. Just the way we always speak during the bear market phase, that this phase too shall pass. So we have a tendency of extrapolating the recent returns. So 6 months back, there was a 6 months back, you had an equity market which had given 60%, 80% return over previous 1 year, 1.5 year on a compounded basis. And last 3 months, last 6 months, you have a scenario that market have corrected somewhere between 10 to 15%. None of these phases are true representative of what an equity fund or an equity asset class can do for you. You should remain invested in equity asset class for medium to long term horizon, and such phases, the returns will be averaged out, be it equity funds, be it equity oriented balance funds, in any kind of equity asset. These such kind of phases will get averaged out. You can look at somewhere closer to the tune of risk-free return plus equity premium, something closer to, let's say, 12% kind of CAGR over a long term from equities. So there is a need for investors to look at equity not from point to point return basis. Probably if you're analyzing funds, then probably you can look at equity funds on a rolling return basis.
Would you say, and now I'm slowly nudging towards the topic that we decided for today, but not yet. Would you say that, Amol, individuals that you have interacted with, or people in general, investors in the Indian equity market,
Yes.
may have misjudged some of the products that they've invested in because of inherent biases, because of recency bias, for example, and the way that equities have performed, and maybe investing in products that may not suit their risk profile? Do you think that there's a distinct possibility of that being the case?
Well, Alex, again, this statement is very much true. Obviously, no statement would be true for all investors, but many of the investors, especially the newcomers, have misjudged this equity market and the phases that we spoke of a couple of minutes back. Now, let me illustrate with an example. Now, people always think that within equity space, large cap will give me less return. Within equity, I'm talking about. Mid cap will give comparatively higher return than large cap, and small cap will give me probably the highest return. Small cap funds or thematic funds. People also forget that along with returns, there is another animal that follows it very closely. That is nothing but risk. So if you are going to invest probably a large part of your corpus or entire corpus in small cap funds looking at highest return possibility, then you are in for a surprise, and if I can use the word nasty surprise. So this risk and return matrix is something that you should be very, very careful, mindful about. And just the way I mentioned that equity is long-term asset class for investments, similarly, we always preach another aspect of personal finance or investments, and that is asset allocation. So asset allocation is not just into debt, equity, gold, international equities. Within equity also, you cannot be completely exposed only to large cap or only to mid cap or only to small cap. Within that also, you have to have different compartments of large cap, mid cap, small cap. If you are a minimalist sort of an investor, then you can probably look at multi cap or a flexi cap couple of schemes, which will have a blend of these asset classes based, market cap oriented different schemes of the mutual funds. That's one aspect. Now, second aspect of people misjudging. If you look at a phase from 2016 to 2020, we know that pharma largely underperformed the market. Typically, it is considered as a sector which is fairly stable because the FMCG and pharma. However, come the pandemic of 2020, pharma gave outsized gains. Now, if you looked at only the phase from 2016 to 19 or 20, you would consider that this is perennial underperformer. And if you look at only the 2020 or calendar 2021, you would feel that this sector is perennial outperformer. Now, both these cases statements are not true. And I think these are some of the levels or aspects where investors, newcomers, or people who have who actually look at only the past returns to make investment decisions, this lot has probably misjudged these type of have made mistakes on these type of examples that we discussed just now.
Context nicely for today's topic, which is equity saving schemes. First of all, what are they? How do they work? And which investor should look at them?
Right. I think that will cover the entire aspect of equity savings fund. Yeah. So let's talk about it. Alex, on this show we have discussed scheme categorization, which was done by market regulator SEBI couple of years, 3-4 years back, 2018. So within that you have several large sections: equity funds, hybrid funds, debt funds. Within hybrid funds you have a certain 6-8 category of hybrid funds. One of them is equity saving. So since it falls under hybrid, it has exposure to 2 or 3 asset classes. One is obviously equity, second one is debt, the third one is arbitrage. So an equity saving fund is a fund that invests minimum 65% component into equity and arbitrage and remaining 35% component into debt. Thereby, this scheme is able to maintain equity taxation. And that's why, what I mean is, which makes it tax efficient. So So equity saving funds are hybrid funds that invest into equity, arbitrage, and debt. Now, that's second question is very important. Who does this scheme? For whom this scheme is suitable for? I would say investors who are conservative in nature, people who will not be comfortable with even a 40%, 60%, 80%, obviously on the higher percentage equity exposure. But people who want to invest into tax efficient assets, as well as people who would like to stay invested for longer horizons and maybe try to get a couple of percentages, 2, 3, 4% more than what a debt asset class is able to generate for you, especially on a post-tax basis. Now, this is the type of investor for whom equity savings funds are suitable.
I want to still focus on how these funds work. You mentioned that they invest in equity, arbitrage and debt.
Yes.
But in what proportion do they invest? And since they are hybrid, is that a dynamic sort of a movement, or is there a fixed sort of a ratio that they invest in?
Right. This is a very good question, Alex. So let's look at the proportion. As I mentioned, equity assets, which is equity plus arbitrage, these two have to have a minimum 65% of component. Let's hypothetically look at 65, 66%, which makes it 2/3 of the component of the scheme. Remaining 33, 34% is invested into debt. Now, to go slightly deeper into this, we have to understand how arbitrage works. Arbitrage is basically the most common example, the old school example is you have two exchanges, BSE, NSE, a stock that is listed on both the exchanges. Stock at one exchange is trading at, suppose, 855 rupees per share. And in another exchange, it is trading at, suppose, 860. Now, buying in one exchange, selling on another is the classical old school example of arbitrage fund, where you try to gain the arbitrage between the price disparity or price fluctuations that exist in different market. That's one example. As I mentioned a couple of times, it's kind of an old school. Now that covered call strategy, which is an option writing strategy, is permitted, arbitrage has gained more significance in equity saving fund as well as other equity funds which invest into covered call strategy. Now, what that strategy is, arbitrage, as I mentioned, is a non-directional equity exposure. So if the market goes up, you will still be able to make the arbitrage kind of returns irrespective of the share prices go up. The same works irrespective of the share prices go down. How does that work? In a covered call strategy, you typically write a call at slightly the price that you want to sell at, which is slightly higher than your today's stock price. In case the stock price does not go to that level, ultimately the entire premium for writing the covered call, you will gain it as an income. The scheme will gain it as an income. If the market price of that stock, if the stock price goes at the intended level, you will anyway able to sell your existing stock. When the covered call settlement comes due, you will be able to sell that existing stock at a higher price. In any case, the fund will be able to make money irrespective of where the market goes up, goes down. I will give example of one scheme in the month of February, March. About 65-66% was the equity exposure, out of which 50% was non-directional exposure. Only the 60%, 16% equity exposure was directional. And as we saw from month of February till now, market has been mostly kind of going down. In such case, having the arbitrage helps your scheme to protect the downside and maybe pocket some kind of premium, as I mentioned, by using covered call strategy. Last component, sometimes the ignored component, is debt component. Now, debt, as we all know, debt will provide you the coupon income or the accrual income. All things put together, I have seen equity saving fund over a 3-year, 5-year, 7-year time frame generating between 8 to 9% kind of return, which is not exactly the equity return, but substantially better on a post-tax basis as compared to the debt options available.
I also want to ask about the composition of this debt side of things.
Right.
Is it that they invest mostly in shorter term securities to prevent the possibility of loss of capital?
Yes, absolutely. In a rising interest rate scenario environment like the one we are in now, if you have a higher modified duration debt portfolio, as you rightly said, you will make capital losses on it. So yes, most of the times the exposure in debt asset class is on a shorter term. It could be anywhere between 1 to 2.5 years, but there is no such rule. Each equity savings scheme will have in their scheme mandate the kind of debt exposure that they will take to, whether it is for accrual income, whether it would be a roll down strategy, whether it will be a credit strategy. Most of the funds today do not run a credit strategy. They run a high quality portfolio of AAA, AA plus. So depending on scheme to scheme, debt allocation will differ. The modified duration will differ, but most of the times it is between 1 to 2 years to 2.5 years or so.
Fantastic. I think we've covered all of the bases, and my viewers have already been able to see the schemes that you've highlighted. You've highlighted 3 schemes for us that our investors can look at, or our viewers can look at. Thank you so much, Amol, for the conversation. It was quite insightful.
As always, a pleasure, Alex. Thanks for having me on the show. Thank you.